So if you're looking at a property that does not cash flow, but you still want to get a mortgage to either purchase or refinance, in this video, I'm going to show you how you can do that. And make sure to stay with me till the end, because in the end, I'll be showing you a strategy that can help you get much better returns for you and your investor by creatively restructuring the capital stack and further reduce the equity that you have to put in. Now, let's quickly go back to the definition of debt coverage ratio. That is income divided by mortgage payments. And the income is usually the net operating income from operating the building. So let's say my mortgage payment is $10,000 per month and my net operating income is $12,000 per month. So I'm debt servicing at 1.2, which puts me in a pretty good situation to get a full loan amount that I'm requesting. But if my mortgage payment is $10,000 and this building does not debt service and only gives me a net operating income of $7,000, so I'm debt servicing at 0.7. In this case, how do I get additional funds or the ideal loan to value to help me complete the capital stack and move the deal forward? Well, it's time for us to be creative and strategic. And let me walk you through a few options. Option number one, you see the income doesn't have to be the net operating income from the building. There are a lot of banks that will take on additional security, for example, your personal earning or business earning if you run a business, on top of the net operating income to help you debt service the mortgage. So let's say you have an operating business that makes you $240,000 per year net. That's gross revenue minus gross expenses. On average, that's about $20,000 per month. And if the financial statements can prove this income is stable, what you can do is you can also use this operating business to co-apply for the mortgage. With $20,000 per month from the operating business plus $7,000 from the net operating income, you're now at $27,000 per month for the cash flow. That is a 2.7 debt coverage ratio on a monthly mortgage payment of $10,000. So you see how that works? This strategy is called global debt servicing. But be careful if you want to pledge your operating business to a lender, because in the case that I just demonstrated to you, you give the lender 2.7 debt coverage ratio, which is way more than what's required. And because now this operating business is going to be encumbered, it will limit you on applying for other credits, such as operating line of credit, equipment loans, etc. and etc. It's like if you've ever been to a casino and you want to play, but you're showing your cards too soon. You want to give the lender enough, but just enough. Option number two. Now let's use the example that we just used. The net operating income from the building is still at $7,000. It doesn't really cash flow. And the debt coverage requirement is still at 1.2. So that tells me your mortgage payment has to stay under $5,833, $7,000 divided by 1.2. So now the mortgage is going to be smaller because the loan is going to be smaller. So you will have to inject more equity into the project using just one debt and one equity to complete the capital stack. And let's call this model number one. And this is how the capital stack will look like. It's a plain vanilla capital stack, consists of one debt and one equity. But if you recall from our last video, some commercial banks will allow you to have secondary financing to be placed behind them. So what you can do is to source a second position mortgage first, and then source the first position mortgage second. Now, very likely you will have to make a payment every month to service the second position mortgage. So that is going to be deemed as expense, which will eat into the net operating income, further reducing the first position mortgage amount. But because you're also getting leverage from the second position mortgage, you can now put less equity into the deal and still complete the capital stack at 100%. And let's call this model number two. So now if we take a look at the capital stack from model number one and model number two on graphic charts, you will see both models will help you complete 100% of the capital stack. But model number two will require you to put less equity into the deal, giving you and your investors better returns on equity multiplier and possibly a better, stronger IRR. So if you are in a situation like this, you need somebody to help you with financing, please go to my website, KaiLu.ca, to book an appointment with me.